Hello, welcome back. I wanted to jump into finishing our sixth lesson here and just talk about an introduction to discount rates. Not a full comprehensive assessment of discount rates, but naturally, as we're doing valuation, we need to discount to get the present value of our payouts. So we do need a discount rate. When I covered the present value in the second lesson, I was just talking about it generally speaking, but now we're going to get into, okay, we need company-specific discount rates. How do we do that? I want to mention, similar we've done in a lot of these lessons, of trying to keep it simple, not overcomplicating things, not trying to recreate the wheel or anything like that. So we'll jump into it right away. Here's a background here, and I think some of these slides will be more of, if you've understood, you had conversations around present value and discount rates, you're probably good to go and well versed on all this. But let's just highlight some main ideas here. We forecast future payouts, but we have to translate them to today's dollar. So we need discount rates. That's not an option here. We're just determining which one. And generally speaking, that's what we're talking about with the cost of capital, right? There is no perfect way to do this. There's different methods, assumptions. Each has limitations. What are we trying to get at here? It's an investor's level of uncertainty, or really a level of distaste for that uncertainty. If I'm investing in something, there's uncertainty whether or not I'm going to get a payout. And so I have to be compensated for that being exposed to that uncertainty, or my distaste for that uncertainty. Standard approaches don't directly measure uncertainty and distaste for uncertainty in the future. They usually look at the historical compensation for things. So when we'll see with like CAPM and beta and everything else, and all those factors, actually it's saying historically what has the market compensated for that. That's fine. That's a good starting point. I mean, it's historical data. It's saying what happened, not what comes next. Obviously in valuation of what comes next. But the argument there is that maybe what happens is the best proxy for what comes next. Discount rate is basically two things. It's like our, a compensation for the time value of money. So that's like, hey, even if I am certain I'm going to get paid back, I still need to be compensated because I would like to consume now, but I can't consume now. I have to wait to consume. So if I make an investment, that's capital I can't spend on, pizza pies, whatever else it is I want to literally consume. If I wait 2-3 years, I can still get my money and use it to buy pizza pies. But I would have to wait for that. So, but then actually the more important one I want to talk about here is the compensation for uncertainty of the payout. And so the what about the fact that with companies, there's no guarantee that they're going to be successful. We're going to forecast that, but we don't know. And it may not work out that way. So it's like, that's where, wait, I'm not sure I'm actually going to get anything. Or like a banker lending arrangement. The company might default, right? The bank, I'm always waiting for my money. But worse than that is there's a chance they may not either pay me in full or pay the interest expense, pay the principal, et cetera. So we have to be compensated for that. That's going to increase our discount rates, right? We're not going to be using risk-free rates here just to compensate for the time value of money. When we're talking about companies, we're trying to figure out how much higher should our discount rate go in an equity valuation when we know that it's got to be greater than just the time value, than compensation for the time value of money. All right. So we can use the weighted average cost of capital if you're doing an enterprise value calculation only with total company value. I actually still would say that this is a little bit of a challenge because it requires circular logic, as I have there in the second bullet point. We would technically need to already know the equity value to calculate a weighted average cost of capital, but we need the weighted average cost of capital to calculate the equity value. So it's circular logic. Is that solvable? Yes. I just would say that you may not have the time and to think through and then understand all that stuff. Simpler way to do it is actually why I would recommend when you're doing an estimate of a company, talking about a company here anyway, that you're thinking about buying shares or stock in, just keep it simple and go forward with the estimating the company's market cap. As I've mentioned, when you're done, if you still need an enterprise value, that's okay. Just go in and add the fair value of debt. So that's, just do addition. That's way simpler than those processes. And that can enable us just to focus on the cost of equity capital. Not trying to actually know the weighting that we would need for weighted average cost of capital calculations. So you could make WACC work. I'm fine with that. But if you're truly iterating through the WACC calculation with the consistently applied, read every footnote, forecast every line, perfectly tie everything out, take no shortcuts approach, that's awesome. But don't just do WACC and not do everything else. Like, here's a good reason that you should be using WACC. When you're looking at a company, have you read every 10K, every 10Q, every 8K? If the answer is yes, I've done everything I can. Like, awesome. That's not going to stump you, right? This will not stump you. If you're 100%, then you're 100%. Keep at it, right? Don't let anything I say change you. But it's more of like, wait, actually, I didn't do any of that stuff. I just downloaded my stuff and I was doing some quick, like, don't be excessive in one area when you missed out on covering the actual information out there. So again, do you constantly read 10Ks and 10Qs and gather every possible fact? then the challenges with WAC are not going to slow you down, and don't let them. But if you're taking shortcuts, right, don't make this be the thing where you spend your time on. Go back and reduce some of those more dangerous shortcuts you're taking. All right. CAPM, capital asset pricing model, commonly discussed, not anything new here. Here's all the pieces. And if you want to kind of take a moment and read this, please do. I just try to talk about all these in straightforward language. It's one way of estimating cost of equity capital. You're effectively looking at the risk-free rate. You're looking at the company's beta, or how you expect that, like the risk of that security relative to a market. And then also thinking about the return on the market minus the risk-free rate, or also called the equity risk premium. So put those together and you can kind of figure out was an estimate for, I should say, what the company's cost of equity capital should be. But I actually want to not emphasize that too much. We don't have to rate the whole process. Let's try to keep this simple. Here's my simplest way for you to think about discount rates. And I'd rather you spend more time thinking about it than doing lots and lots of calculations, mainly because even if you do a beta calculation and you run your regressions, you're saying the historical compensation, and that's still different from future compensation. And you still have to rethink, is the past the same as the future? And if so, why? So before you start levering and unlevering beta and all that other stuff, and if you don't know what I'm talking about, good for you, you're ahead. Just remember that it's still limited because you're assuming that the aspects of the past would be the same, but many things could change. Just think about this in general. Cost of equity is the risk-free rate plus the equity risk premium, meaning like what I have to be compensated at risk-free rate for time value of money, knowing that I'll get my money back. On top of that, I also have to, equities are not a guarantee. Even well-run companies, it's not a guarantee. We don't know the future. Nobody does. So I have to be compensated a little bit more. And then this is kind of the idea of beta, but I'm just recommending you think about it. If you're saying the company is riskier than average things in the market, then you need to increase this a little bit. If you think it's less risky, you could decrease it a little bit. So like just have that basic conversation, which is that risk-free rate plus equity risk premium. And then if I'm making my argument, and where are you making that argument? Revenues and expenses. If you think there's a chance that the revenues could drop 20%, and that's a reasonably high thing, you think you can see margin compression, like then you probably want to, there's great potential, but there's great risk. You probably want to be using a higher discount rate, higher than just the market on average, which was what I have here. If you think they're really stable and secure, and the company I'll just use here is like, look, if you're talking about a Costco, they're pretty stable, secure, have worked in all different kinds of economic scenarios. If you want to use that as an argument, Costco, Walmart, to say maybe they're a little less than, I'm okay with that. Have that conversation, right? But, don't take some still not profitable, high flying, company in the AI space and be like, yeah, I'm using a low cost of capital for them. Maybe it's a great opportunity, but like you can't argue there's not some risk for a variety of things that are unproven. So you're talking about an unproven company and you want to argue they've got a great potential to quadruple their revenue in the next 4 or 5 years. Okay, let's have that conversation. Let's listen to your perspectives. I'd love to hear what you have to say and your reasons for the how, not just the what of valuation. But don't also try to argue that that's significantly lower than just investing in the S&P 500 or something like that. And if you're looking at a really stable, secure company and you want to go a little bit below, kind of the historical compensation for the market, okay, have that conversation. Talk about why that is. I certainly would want to listen to it, right? So a back thing here, my comment about we don't need to recreate. This is just my chart that I looked at from Y charts, not my own work, of course, here, of like the risk-free rate. And we're in an interesting time where we spent roughly 40 years where it was kind of dropping, not exactly in a linear fashion, and then it's gone up where it kind of higher rates for the U.S. Securities. So right now, it's at 4.95 for the 10-year Treasury as of when I printed this, October 25th, 2023. But get your own version of this, right? Whenever you're watching this, it's not that day because it already passed. Don't try to, you don't have to, just look it up. I guess that's my point. Look up the risk-free rate. This is an accessible thing if you have access to the internet. If you don't have access to the internet, I don't think you should be doing valuation anyway. I would never challenge the market on anything with knowing that I don't have access to the internet, right? I would think about what's going on there first. All right, so look this up. That's the risk-free rate. We don't need to recreate this. Second thing here, equity risk premium, right? I'm not the one who calculated this. This is from Statista. What is the point I'm just making here? Well, you can actually look this up too. And this one is not, it's exactly this, because you can see some fluctuation over time. But what is this? It's like roughly 5.5% over those from 2011 to 2023. You could go out further if you want to look back, but my thought here is like, I'm going to look at roughly the last 10 years. I know it's not exactly 10 and say, hey, it's roughly 5.5%. So if I put those two together, I'm going to round, right? I got 4.95 right now. I got 5.5%. If I put those two together, I'm getting it like 10.5, right? A little under 10.5. So if I'm going to discount something, 10.5, I'm going to go a little lower. Okay. I think there are some companies you should make that argument for a little bit higher if these things change, right? Again, because you need to update this with updated information whenever you're watching this. As these things change, I said that wrong. As these things change, go out and seek updated information, but this is not for us to create. We're thinking about, right? We're going to go and be consumers of the risk-free rate. Whatever the prevailing risk-free rate is, go get it, use it. Go look up, get an updated version of the equity risk premium just in case something has changed. Go get that stuff, think about them. And then what do we want to do? All right, now that we have those two things, I'm going to consider, all right, the company that I'm looking at, do I think they're less risky or more risky than the market? And in terms of what? Really, I would say the main things are in terms of revenues and expenses. Is there a revenue at risk where it could drop? Could their expenses rise? Could they be exposed to something where expenses rise even though revenues don't? Could they see margin compression because they have to pay more for components? Are their customers very price sensitive, where if they would try to pass on a thing because of inflation, it would take a hit, right? Think about those aspects and then use that to say, all right, should I increase or decrease my discount rate? So that's my general idea: is gather the information externally and then just thoughtfully apply it to your company. And no matter what, gut check it. Whatever cost of equity capital you're using here, just make sure, does this make sense? And is it consistent with my thesis? If you're talking about a company you expect to grow at 120% for the next 6 years, do not tell me that's less risky than the market, right? Just, okay, great. You're talking about you're talking about a high reward opportunity. That's almost surely going to be a high risk opportunity as well. And you could be right, but just make sure you have a consistent story. Gut check your discount rate. It should be a part of your broader conversation on the company, not just a separate thing. All right, that's it for this one. Hopefully it was valuable. Take care.